If you think the housing crash is only a scary headline, this video may change your mind. Right now, there are cities in the United States where the boom is fading fast. Prices that felt untouchable in 2022 and 2023 are slipping. Listings are sitting, sellers are cutting, and in some neighborhoods, the American dream looks a lot more like financial quicksand. In this video, we're taking a straight look at 10 US cities where the 2025 housing slowdown is already very real. Think of it as a simple roadmap through some of the most fragile markets right now. Some of these places were the stars of the last boom. Now they are quietly becoming warning signs. Stay with me all the way to number 1, because the last city on this list is the clearest example of how fast a hot market can turn cold. Before we start the countdown, let's set some ground rules. This video is not about fear for clicks. It is about giving you a clear picture of where the pressure is building in the housing market and why. None of this is personal financial advice. We are not telling you to buy or sell in any of these markets. Use this as a starting point, then talk to local professionals and do your own research. With that said, let's get into the list. Number 10, Fort Myers, Florida. Fort Myers was one of the classic pandemic boom markets. Remote workers, retirees, and second home buyers rushed in. Sunny weather, beaches, and what looked like cheap Florida pushed demand through the roof. For a while, it felt like any house with a roof and walls would sell in days. Prices moved up far faster than local wages. Fast forward to 2025, and the tone has changed. Inventory in and around Fort Myers has climbed. More homes are sitting on the market for weeks or months. A growing share of sellers are cutting asking prices to get a deal done. On top of that, Florida's big problem is hitting home here: insurance. Major storms and higher rebuilding costs have pushed insurance premiums sharply higher. Some insurers have pulled back altogether. For many owners, the monthly cost of the house is no longer just the mortgage. It is the mortgage plus insurance plus HOA plus taxes. When all of that jumps at the same time, demand goes soft. Fort Myers is not a ghost town, but for the first time in years, buyers here can take a breath, look at multiple options, and negotiate. That shift in power from seller to buyer is often the first stage of a real correction. Number 9, Colorado Springs, Colorado. For most of the last decade, Colorado Springs was treated as the affordable cousin of Denver. Same mountains, same outdoor lifestyle, easier commute, lower prices. That story pulled in a lot of people. During the boom years, listings were scarce. Buyers wrote emotional letters. Bidding wars were common. Now the picture is different. The number of homes for sale in Colorado Springs has climbed back to, and in some cases above, Bow's pre-pandemic levels. Months of inventory have moved toward what agents call a balanced market instead of an extreme seller's market. What does that look like on the ground? Houses sit longer. The first offer is not always the best offer. Sellers are more open to inspection, repairs, and credits. And instead of seeing price records every month, you start seeing flat lines and small step downs. Colorado Springs is a great example of a city that was never a huge bubble on paper, but still overheated. When a place gets discovered and money rushes in, it does not need national headline prices to feel the pain of a slowdown later. Number 8, Orlando, Florida. Orlando is more than theme parks, but tourism and hospitality do shape this market. When the world reopened after lockdowns, demand snapped back hard. Investors bought vacation rentals. Workers returned. People who always dreamed of living near the parks made their move. That rush pushed home prices up quickly. By 2025, a different pattern is clear. Many parts of Florida are now reporting longer selling times, more active listings, and a very high share of homes with price cuts before they sell. Orlando is part of that wave. Mortgage rates are higher than they were during the boom. Insurance is more expensive. Not every service job can support a large mortgage plus rising costs. So what actually happens? Buyers become picky. They skip dated homes. They pass on properties with flood or storm risk. And when a seller prices a house as if it is still 2022, the market pushes back. The home sits, and then the price gets cut. None of that shows up as a dramatic crash on TV, but for owners who thought the only direction was up, a few years of flat or slightly falling prices can feel like a shock. Number 7, Dallas, Texas. Dallas has been a magnet for companies and people for years. Major employers moved in. New suburbs exploded outwards. For a long time, the story was simple. More people, more jobs, more demand, higher prices. But even strong job markets can get ahead of themselves. In 2025, Dallas is seeing something it has not seen in a while: a clear rise in the number of homes for sale, and a noticeable increase in price reductions across many neighborhoods. Builders who started projects during the peak are delivering new houses into a softer, more cautious market. Some buyers who stretched to buy in 2022 now face higher taxes, insurance, and living costs, and they are listing their homes again. The result is a slow but steady shift. Instead of 10 offers on the first weekend, you might see 1 or 2 serious buyers after a few weeks. Instead of buyers waiving inspections, you see detailed repair requests. Instead of take it or leave it pricing, you see back and forth negotiation. That does not mean Dallas is finished as a city. It means the easy money phase is over. If you treat a booming market as if it can never cool, this is the wake-up call. Number 6. Jacksonville, Florida. For years, Jacksonville was marketed as the affordable alternative to more famous Florida metros. You had port jobs, logistics, military presence, beaches, and a cost of living that undercut Miami and Tampa. That combination attracted a lot of people in the last cycle. Prices climbed fast from a lower base. By 2025, the growth story is running into limits. New construction has added more supply. In-migration has slowed from its peak. And the same Florida problems, insurance, storm risk, and rising fees, are starting to weigh on buyers here too. On the ground, agents in Jacksonville talk about more listings sitting unsold, homes coming back on the market after failed contracts, and sellers who insist on peak-era prices, only to cut later. For first-time buyers who were crushed by bidding wars in 2021, this cooling is a relief. For investors who bought on the assumption of endless appreciation, it is a different feeling. Jacksonville shows how quickly an undervalued market can start to look fully priced once the music slows down. Number 5. Phoenix, Arizona. If there was a poster child for the pandemic housing boom, Phoenix was near the top. Investors, retirees, and remote workers poured in from higher-priced states. Single-family homes turned into rentals. Subdivisions sold out before the roads were even finished. Then reality hit. Higher mortgage rates took some buyers out of the game. Some investors pulled back. Inventory began to climb from rock-bottom levels. At the same time, long-term concerns about water in the Southwest stopped being an abstract idea and started showing up in headlines. In 2025, Phoenix still has strong long-term fundamentals: jobs, sunshine, and relative affordability compared with some coastal markets. But the pricing is adjusting. You see more price-reduced banners on listings. You see sellers offering closing cost help or rate buydowns. You see buyers walking away from deals that do not feel right instead of begging to be accepted. For anyone who believed Phoenix would behave like a one-way stock chart, this phase is a reminder that housing is still a market. Markets correct. Number 4. New Orleans, Louisiana. New Orleans is unique. It has culture you cannot copy, a history you cannot fake, and neighborhoods that feel like nowhere else in America. It also has a challenging housing market in 2025. Insurance costs in Louisiana have climbed sharply, especially for older homes and for properties in flood risk zones. Some insurers have left the state or raised premiums so high that owners are forced to make hard choices. When the cost to carry a home rises faster than incomes, demand falls, buyers step back. They hunt for smaller places, different neighborhoods, or different cities. Home prices in New Orleans have started to reflect that pressure. Instead of steady gains, you see flat or gently declining values in many areas. Homes sit longer, sellers negotiate more. For long-time residents who love the city and plan to stay, lower prices can be a bittersweet blessing. For anyone who bought at a peak and expected to flip or cash out quickly, the math no longer looks so friendly. New Orleans is a reminder that housing markets are not just about interest rates. Local risk, storms, flooding, and insurance feeds directly into prices. Number 3. San Antonio, Texas. San Antonio has long been known as the more stable, affordable sibling compared with Austin or Dallas. It has military bases, healthcare, tourism, and a reputation for steady, not crazy, growth. Even so, the last few years pushed prices up faster than usual. Low rates and strong demand drove a mini boom of its own. By 2025, we can see the after effects. Inventory is higher than in the boom years. Homes stay on the market longer. Some of the sharpest price increases have softened, and in certain segments, prices are slipping compared with a year ago. The pattern is simple. Local wages can only stretch so far. When home values jump far ahead of what residents earn, something eventually has to adjust. For buyers, San Antonio in 2025 offers more breathing room and more listings to choose from. For owners who bought expecting 2 or 3 years of double-digit gains, the reality of slower or negative growth is hitting now. San Antonio is not crashing. It is normalizing. But normalization after a boom can feel a lot like a downturn if you were counting on endless appreciation. Number 2. Tampa, Florida. Tampa was one of the hottest Sunbelt markets in the last cycle. Remote workers, investors, and retirees all wanted in prices moved quickly. Multiple offers and waived contingencies became standard. In 2025, the market is finally exhaling. Several signs point in the same direction. More homes for sale than a few years ago, a high share of listings with price cuts before they go under contract, and buyers who are no longer afraid to walk away. Add in rising property taxes, higher insurance premiums, and ongoing storm risk, and you get a different picture than the glossy ads suggested. For people who always dreamed of moving to Tampa Bay, this cooling may be the first real window in years to buy without panic. For those who bought second homes or rentals on thin margins, it is a stress test. Tampa shows a classic pattern of a boomtown coming back down to earth. Not a collapse, but a steady, grinding adjustment that eats into paper gains. Number 1. Austin, Texas. For a few years, Austin was talked about as the next Silicon Valley tech companies opened offices. Startups moved in. Remote workers with big city salaries arrived and bid up everything in sight. Between 2020 and 2022, prices in Austin jumped at a pace that stunned even long-time locals. By 2025, that story has turned. The number of homes for sale has increased sharply compared with the boom years. New construction that started during the frenzy is now finishing. Some out-of-state buyers have left or decided not to come. Mortgage rates are higher. Affordability is stretched. On price charts, Austin is one of the places where you can clearly see a peak and then a step down. In real life, that means sellers who price as if it is still 2022 sit on the market. Buyers can actually negotiate again. Investors who counted on fast appreciation are rerunning their numbers. None of this changes Austin's long-term strengths: a young population, a strong job base, and a desirable lifestyle. But it does change the short-term math. If you buy in a boom expecting the boom to last forever, Austin is the case study you should be looking at right now. So what do these 10 cities tell us about the 2025 housing market? First, there is no single story. National averages can say prices are stable, while on the ground, some markets are quietly giving back gains. Second, the same ingredients show up again and again. Fast price growth during the boom, local incomes that did not keep up, new supply arriving late, and extra pressure from things like insurance, taxes, water risk, or shifting demand. Third, a crash does not always look like a movie. Sometimes it is a slow leak. A few price cuts here, a few failed listings there, 2 or 3 years of flat or slightly down values. For anyone who bought at the top, that slow leak can hurt just as much. If you live in one of these cities, none of this means you have to panic. It does mean you should know what is happening around you, not just what national headlines say. If you're thinking about moving or investing, use this video as a map. Ask hard questions. Look at local data. Talk to more than one agent or lender. And if you want us to break down safer, more stable markets, the places where prices are still reasonable and fundamentals look solid, let me know in the comments. We may build our next video around that. Thanks for watching, stay informed, and we'll see you in the next one.